Hey, good morning, everyone. Yeah, thanks for coming. Hopefully everyone have a good morning. I just arrived yesterday from New York. I'm Jonathan, CEO at Euler Labs. Thanks for tuning in. And today we're going to spend a little bit of time talking about how Euler is helping creating utility to the RWA markets, but also solving a few bottlenecks from the technical implementation of a lot of RWA assets as they enter onto the blockchain. I think I'm going to give a little presentation for about 20 minutes, but I'll leave some time at the end for questions. But feel free to ask questions at the end of each slide. I want it to be a little bit more interactive instead of me just talking nonstop for 20 minutes. Yeah, so. Yeah, so a little bit about myself. I'm Jonathan. I joined crypto full-time in 2020. Initially was, there's a lot of seats. Feel free to jump in. Yeah, I joined crypto full-time in 2020 in the venture capital world. I worked in traditional finance before that. I saw huge opportunities of the convergence of DeFi and TradFi. And finally seeing that convergence really happening in the last couple of years. It's really accelerating. And working in DeFi, borrowing and lending space has been super rewarding and humbling at the same time. Kind of see that come to realization. And I think this year is really going to be inflection year for RWA lending. And we've been talking to all the asset issuers about some very exciting new assets that's coming on chain. That allows user get access to a lot of different asset classes that they're not able to in the traditional way. But DeFi is a huge unlock to really open the access to users on a lot of different investment opportunities and financial tools for them to really realize their financial goals, leveraging all DeFi that can offer. And Euler is definitely part of that. Assuming you guys already probably heard about Euler already, but yeah, on the high level, we are borrow lending primitives, being in the space since 2020, we're working accelerating with institutions this year, but has been working very diligently and actively with DeFi native users for the last 4 or 5 years. To start off, there are a couple of bottlenecks to allow RWA assets to come on chain. There are a few, like these are the 3 main ones, but there are many others. I can kind of dive into a few in the later slides. But some of the key ones are risk isolation, composability, and compliance. Most of the lending options right now can do 2, but not all 3 of them. So risk isolation means there's no shared exposure across different vaults and markets. So if one vault get hacked or there's some incidents with the collaterals, the risk is not contagious to other markets. This is super relevant to RWA because each RWA assets behaves very independently sometimes, especially the private credit markets. Each private credit is structured very independently, and there is a lot of esoteric risk associated with each assets. So having the modular risk isolation module really unlocks the safety and helps with scaling and acceleration of the adoption of RWA assets to retails and institutions. Composability, I think this is something you guys already are pretty familiar with. This allows capital efficiency, cross-collateralization, and really allow RWA to be integrated with a broader DeFi ecosystem. So if Fidelity issues a ETF on chain with through tokenization, and you wanted to move that effectively on chain, and through composability, you can borrow against that assets using various stable coins. And that means it really taps into the full scope of DeFi. And for compliance, this is a unique requirement for RWA because a lot of these assets in different jurisdiction does require different compliance requirements. So for example, we recently launched a partnership with Securitize. A user can get actual ownership of the underlying assets through they call it a digital security token, DS token. But this does require a very specific set of KYC, KYB gating, and sanction screening, regulatory permissioning. And the elegant solution that Euler has built is to allow that at the smart contract level instead of adding 10 different add-on tools just to make it work, right? So we can really allow it in a very elegant fashion at the smart contract level. So these are the 3 big categories I will probably spend a little bit more time on. Some of it is really unique to the RWA space. This is related to the risk isolation. As you guys know, in DeFi borrow lending, there are 2 popular architecture design. One is the shared pool architecture, another one is modular. So Euler is more on the modular side. So on the shared pool architecture, the advantage of that is very highly efficient. But if one of the market is compromised, it means massive implication to the entire protocol. At Euler, we believe risk isolation is really key to protect users and also protect anybody that's involved in the ecosystem. So if one pool is impacted through the collateral or through smart contract hacks, it's not impacted to the broader ecosystem. So the damage is very much contained. This is really already very highly relevant to DeFi. As you guys know, there are a lot of very famous hacks throughout the years that risk isolation is really key. But with RWA, it introduced a new layer of complexity, especially with a couple of uniqueness that RWA asset has. One is, for example, the NAV delays. One example is the Apollo Private Credit Fund. So the Apollo Private Credit Fund is very popular. It's being talked about very frequently with institutions, also retails, as a key examples of how RWA assets can come on chain, how top-tier institutions are thinking about crypto. But the challenges that come is a few things. One is the NAV delay, meaning that how these assets are marked to market. In DeFi, we're very used to atomic settlements. Things can just settle within seconds, but TradFi moves in a much slower pace. These private credit funds are settled on T+1, T+3, or even longer, meaning that if you purchase the fund, it will settle days later to confirm that you have the ownership of the fund. So this really creates a lot of issues on DeFi because we need to value the real-time value of the collaterals in real time so that we can issue loans based on the value of your collaterals. And also, with the Apollo fund, it has a redemption period of 3 months, meaning that if you miss a certain redemption period, if you wanted to withdraw and get out of your position, it can take up to 3 months, which is a huge problem in DeFi. So there are a lot of issues like that with unlocking RWA assets onto DeFi, and that we are solving, not just us. There are a couple other protocols that allows marketplaces where we can solve the NAV delay issue. And some of the other protocols are like thinking about creating a free market for the settlements, for also the redemption period. So there are a few other projects that we're talking to, and also for liquidation as well, to really solve different pieces to allow a DeFi similar experience with these limitations that we are dealing with on the RWA assets, especially on the fund side. So this is just on the shared pool. Yeah, I think I already touched on a lot of these, but in summary, I think to allow what RWA really needs, to allow a very smooth user experience, we need isolated market, because these assets does move very idiosyncratically. We need to make sure users are protected at the vault level. 2 is compliance enforced. So this mostly related to institutions, because they wanted to be super compliant. They wanted to make sure they feel comfortable entering into DeFi. So having compliance measurements and tools at the smart contract level is very key to onboard these institutions, especially with RWA, because they already hold a lot of these assets. so they can come on chain, use collaterals, and borrow against with stable coins and other blue chip assets. Risk measurement by domain experts. This is what I mean by risk curators. This is widely adopted by Euler and Morpho modular lending protocols like this. And it doesn't make sense for somebody that's not very well in traditional finance risk measurement to run a DeFi vault risk to risk parameters. So Euler work with a few top-tier risk curators in the space to set risk parameters. This includes supply borrow caps, loan-to-value ratios, and all these other risk parameters that Euler's allow these managers to control the risk, which I can expand a little bit beyond, because you need a deep understanding of each RWA assets and the risk associated with those assets to protect the user, right? So their role is to make sure we're not lending out too much money, but we're maximizing the capital efficiency in the vault. 4 is we have to allow cross-collateralization at a contained scale. So this is the uniqueness to Euler's architecture. We don't just do super isolated modular pools, but we can customize these modular pools to create multiple cross-collateralization in a more safe and controlled way. The 5th one is permissionless deployment. So we're still DeFi, we're open access, so people can list assets still in a permissionless manner. I don't think it makes sense to submit a government's proposal for people to be like, oh, hey, shall we open a market on the Fidelity 3-year treasury versus the Franklin Templeton 10 years treasury? So this will create a lot of delay and create a lot of like unnecessary process for users to decide, especially retail users who are not like tracking these on a day-to-day basis. So we will have a permissionless deployment working closely with curators to open these markets as we see market demands and risk assessments. Any questions so far? Yeah.
I have a simple question.
Yeah.
So, you addressed a lot of the issues. Hi. You addressed a lot of the issues, and you had a point with regards to NAV delay.
Mm-hmm.
So you talked a lot about price discovery and how you see that. But like whenever we're talking about RWAs and we want to bring DeFi native experience to the RWAs, like would you expand on the NAV delay thing? Like how do you address that so that it is reduced?
Yeah. So,
sorry if it's a previous point, but
no, yeah, this is actually a key point because a lot of people are. So I work in traditional finance, but whenever I talk to people who hasn't worked on traditional finance, they're a little bit confused about how these private bonds and private credits are priced in real time. So, for example, a lot of these private credits funds, they issue loans to small businesses. Right now, a lot of it is issued to AI companies to build data centers and to fund these RWA R&D efforts, right? So small and mid-sized enterprises, they are most of the borrowers in these private credit funds. And the issuers of these private credit funds, they aggregate these loans together and issue a fund and sell it to interested investors at a higher interest rate than the treasury that you can get. So the delay on the valuation of these funds, meaning that the healthiness of these small to mid-sized businesses are not public traded, right? So their financial performance is not super liquid. So there's a lot of delay in information in terms of how healthy are these private credits are doing. So sometimes if you discover something that's drastic, these private credit funds can get discounted significantly. So the value of your collateral, if you use tokenized version of those private credit on chain, can get slashed like 30-40% if they get downgraded by some credit risk rating agencies. So that's what we call the NAV delay and also the sentiments, meaning that if all of a sudden the rating got downgraded, we will face a lot of utilization pressure on the on the lending market because the value of the collateral suddenly dropped and reaching a high utilization ratio on the lending vault, right? So it creates a lot of stress that way. Yeah. So we're thinking about ways to kind of smooth the curve and also getting ahead of the game. But yeah, this is a hot topic right now about onboarding private credit to lending markets. Yeah. So.
I have a question to the similar direction. I mean, what you're talking about, the NAV delay, it's true for all markets on the weekend. So how do you deal with, like, you can't liquidate 20 billion worth of gold over the weekend. Like, it's an issue for every asset that's not traded 24/7, right?
Yeah, so the liquidation is one of the key discussion topics. That's why the modular lending design work makes sense, right? So because each assets to liquidate in a graceful manner, you need to work with large liquidity pools of organic trading volumes of these assets, so that when liquidation happens, the collaterals can be offloaded in a more graceful way, meaning that there's not huge discounts when we're trying to when the liquidation partner trying to sell these assets to offload them, right? And with the illiquidity nature of these private credit funds, sometimes these can be user cannot offload these assets in definitely not seconds, sometimes with hours or even days of delay, right? So to open these markets, we have to make sure, so from the lending protocol side, we have to make sure there are liquidity partners that they can liquidate at a certain volume on a daily basis, right? So this is the active conversation we're having with the curator, with the liquidation partner, to make sure we can offload these assets. If we cannot, we usually tend to delay the market launches. Yeah. So yeah, this is just to give you guys a sense, like, we're solving a lot of the new problems that's coming onto DeFi, because this is not what we're used to. We used to open like Bitcoin and ETH markets, and these can be settled in seconds. But with these financial instruments, they move at a different speed with different measures. But to really fully unleash their potential, I think there are a lot of innovation that's currently happening. Yeah. I think I already talked about a lot of these. Yeah, this is give you guys some example of the recent partnership we have with Securitize, with a couple of private credit and treasury bond assets. We're also discussing with them on the tokenized equity, tokenized stock index products. So with Securitize, user can actually get the direct ownership of the underlying assets through their tokenization strategies. But if you guys look at other tokenization platforms like Centrifuge, like Ondo, they sometimes use different legal wrappers. You get different legal ownerships of the assets. With Securitize, you do get the direct ownerships, but that means more severe regulatory gating, KYC, KYB, and a lot of lending markets cannot allow that right now. We're one of the few that's able to implement a lot of these capabilities on the left-hand side at the smart contract level. This is a point on the cross-collateralization. So we do isolate the risk at the vault level, but from the user's perspective, on your user's account level, we do allow cross-collateralization. This is Euler's unique advantages on capital efficiency does come in play. So if you do hold tokenized equities, you do hold tokenized treasuries or bonds, you can borrow USDC against a portfolio of your assets. And we have the smart routing of different assets at different pools, but we do connect them through the Ethereum Vault connector. We have a white paper on that. Happy to share with you guys later on how that works. Basically, we route these assets to different isolated pools, but from the user's experience perspective, you can borrow USDC with your portfolio without trying to do this manually through 10 different markets. So this is where the cross-collateralization can work. This is a little bit about the curation model. I think a lot of people are not super familiar with this point. You guys can think about Curator as your asset manager. So in TradFi, you can think about like JP Morgan or Franklin Templeton or or Apollo, they are sort of the TradFi risk creator, and some of them are actually coming onto DeFi. Apollo just announced they're being active risk creator on DeFi as well. So they are managing the risk of these vaults. So we are the infrastructure builder. We provide the behind the wall piping on these vaults. But the one that's actually setting risk parameters on each asset that does a lot of diligence on how risky a certain collateral is are conducted by these creators. And us at Euler, we wanted to make sure the risk curators that we partner with really understand how DeFi works, how traditional finance works, and they set the right risk control measurements so that the user's interests are protected at all times. So some of the risk curators that's active on Euler are on the bottom right-hand side, Centaura, KPK, Concrete, K3, and a few others. I'm actively talking to a few others, including Apollo, Bitwise, and you guys will see more traditional institutional grade risk curators coming on chain because they really see their expertise from traditional finance can translate into DeFi, and they're getting themselves educated on how DeFi can work, and we're helping with that education process. And with more higher quality risk manager and curators onto the space, I think this will really unlock a lot of the new RWA assets coming on chain with people who actually understand them and set the right guide rail so user feels safer that way. So in the future, user can freely select which risk curator they trust and deploy their assets just with at the curator level. So we will have a few options for user at each assets, each RWA, and user can select, oh, I trust Apollo or I trust Centaura because they really do a lot of diligence on these markets. They have a good track record, never have any incidents. So user have full freedom on select which risk curator they trust with their money. Yeah. Another example I wanted to show you is another type of RWA that's coming on chain, that is tokenized equity. This is very exciting because especially with user outside of the USA, they sometimes wanted to get exposure to US stocks. And once they get the US stocks exposure, they wanted to borrow against them. So that's what we've been talking to a lot of institutions and retails on this point. So we launched with Ondo Finance on the S&P 500 index, NASDAQ, and Tesla. We're onboarding more individual stocks and indices that can expand beyond the US stock market, that can go to Japanese stock market, European stock market, and Hong Kong, right? So there are a couple of other options that we're unlocking and bringing them on chain. This is another example of how we can open up access to user across the world to allow them to get exposure to different financial instruments and borrow against them through the lending protocol design. Yeah, and I do wanted to kind of show you how this can work. So to allow tokenized equities on chain, a few partners has to involve here. So at the bottom row, you can see Ondo Finance, they tokenize the stock, put the legal wrapper on top with the NAV tracking framework as well. Then Chainlink help us with the risk oracle. Currently, these tokenized stock markets are 24/5. We're working with Chainlink to unlock 24/7 as well. We're doing a lot of testing on the weekend trading because the data is a little bit thinner on the weekends because TradFi does close, crypto doesn't. So this is another key differentiation with the stock market that's different from the bonds. Centaura is currently being selected as the risk curator to run the risk management of the vault on a day-to-day basis, and Euler provides the underlying isolated vault infrastructure. So what this enables, right? So DeFi borrowing and lending really enables a few of key categories of assets to coming on chain. We used to only be dealing with ERC20 tokens. Now we can deal with tokenized treasury. That can include cash and cash equivalent treasury bonds, stable coins, tokenized equities, and private credit. But also, while we are bringing all these different asset classes on chain, we can build it in a permission or permissionless way, permission mostly for institutions, and also to allow permissionless deployment, meaning that we keep the platform open. Any asset issuers can list their assets with us, and it just has to be approved and go through the diligence process with our risk curators. Yeah. And you guys probably already know, like RWA assets is growing super fast, and we're super excited about opportunities here. So, yeah, do you want to leave some time for questions? Yeah.
Thanks a lot for the talk. Very, very instructive.
Yeah.
What other asset classes do you see going on chain after credit lending and tokenized equities?
Yeah, we're talking about, so tokenized equity is a big category. We're doing a ton of diligence on private credit. There are a lot of issues that I will talk about. Right now, with the macroeconomic environment, we are being extremely careful with private credits because these assets can get downgraded as you guys keep following the news, right? But we are allowing shorter duration, like daily settlements, bond structure. So these are mark-to-market of way more highly frequent level, so that's way more DeFi friendly for us to unlock next. Another type of asset class we're thinking about is commodities. This can include gold, precious metals to start with, but other type of commodities as well. But I think we're going to start with some precious metals first, because there are already a lot of tokenized gold on DeFi, on crypto, and we're unlocking that part first. But we're constantly monitoring other type of assets. Yeah, working with major tokenization platforms like Centrifuge, Ondo, and all those folks. Yeah, so.
Hey, thanks. Thanks for a great talk. I just want to also to ask you, what's your view on how you're going to be handling the extended liquidity fragmentation? Because on TradFi, the liquidity is fragmented, and here we add another layer of fragmentation with different tokenization issuers, and that kind of creates another set of complexity.
Yeah. So this is the unique design of Euler that can unlock, right? So if we can isolate the risk by meaning, like if we wanted to open the private credit markets, we don't want it to connect with other vaults that we have because it's permission or we think it's too high risk, we can do that. But for example, the tokenized equity market, you can hold multiple different types of tokenized equity, like the indexes or the Tesla stocks. We're onboarding a lot of individual stocks, and you can have a portfolio of these stock assets. But if you just want to borrow for USDC or PYUSD, it's highly capital efficient that way. Like we allow accepting multiple assets from the same categories to kind of allow users to borrow the same type of stable coins that way. So multi-assets collateral is currently live on Euler. We're thinking about working with some large institutions on other capital efficient designs to allow users to tap into that. Yeah. So.
Yeah. I mean, different tokenizers, like for example, on the Xcos, etc. How will they kind of cross-lending?
Yeah. So that's currently under discussion because we're thinking about launching Xstock as well, like that you mentioned. Once the market is live, we will talk with both of them. Be like, hey, if the underlying stock is the same, like, can we make it more capital efficient? So there has to be a coordination between the price oracle provider and also the risk curators, right? We have the tools to connect these markets together, but we do want to make sure the underlying standards are the same, the price, fee, speed are the same, so there's no like discrepancies across different markets. Yeah. So. Yeah.
Like two-part question with regards to scaling. So you mentioned the Ondo solution and their wrapper, the ERC20s, and so that you don't get the underlying asset. Do you see those kind of structures as not really quick in terms of scaling? And the second part is with regards to new categories, is there a way or like any vision for the real estate or commercial real estate solutions that can be done?
What's your second question again?
The real estate. So,
Yeah.
is there a possibility of like tokenized real estate, so like bringing it on chain, or if something can be done there?
Yeah. I think we've actually been talking about real estate for a very long time. These assets actually face a lot of the same limitations with tokenized bonds, sometimes even worse, because the mark-to-market is very slow. We are talking about, like, we're talking to some REITs issuers, because they have more kind of mark-to-market data on a daily basis from traditional finance. One of the highlight I do want to mention is Figure Markets. I'm not sure if you're familiar. They issue a HELOC loan. Basically, if you are real estate owners, they issue a loan to you, and they have a CLO kind of credit facilities to aggregate these loans together and use them as a credit facility and a private credit kind of structure. That we're actually talking to Figure Markets. They are just publicly listed in the US. They've been building kind of real estate flavored loans on crypto natively for many years. I'm very happy to work with them. Actually, I'm talking to one of them on stage at the RWA Summit tomorrow. So if you guys are going, like, definitely tune in. But I can share the high level afterwards on Euler's Twitter. Yeah. So yeah.
Okay. Hi. Great talk, by the way. I just met a couple of things. But anyways, my question is sort of related to his question about liquidity fragmentation, right?
Yeah.
I'm curious how the settlement works if you have to, like, move borrowed value across chains. So I don't know if that's something you can talk about. Yeah.
Yeah, so a lot of the liquidity currently is on Ethereum main chain. We are working with a couple of L2s and layer zeros, protocols like that, to make sure cross-chain capital efficiency is being solved. Actually, there is a lot of encouraging conversation with layer zero right now, especially with their announcements with the zero chain. We're designing some custom solutions leveraging their cross-chain solutions. But right now, a lot of the liquidity is on Ethereum main chain. We launched the tokenized equity and a few other, like, markets currently on the main chain. But yeah, we're in active discussion with a lot of L2s because they do want to onboard a lot of RWA, but they are still a little bit early, I would say, those conversations. And initially, I do think there are some level of liquidity fragmentation. But I think Ethereum will always be, I think, a huge liquidity hub for us. And yeah, actively talking to kind of interoperability protocols to solve that. Yeah, so. Yeah.
Hi, Jonathan. Thank you very much for your presentation. I got a question about the potential systemic risk of bringing on-chain instruments. Traditional on-chain credit instrument on-chain. We've seen that with the issue with Resolve of having hard-coded Oracle on the protocols. And my question would be about the fact that we could have potential risk in borrowing, allowing people to borrow against illiquid assets, because on-chain traditional credit instrument brought on-chain don't have mark-to-market price, and they are basically hard-coded with redemption oracle. I don't know the time frame on which the update is made, but couldn't we have any systemic risk about this matter, given also we don't have any secondary liquid markets for protocols to liquidate those assets, so it could incur bad debt at the protocol level?
Yeah, so a good question. I think the current solution is we're actively working closely with risk creators to assess how we can gracefully liquidate, or how can we gracefully have frequent mark-to-market data on these assets. Working with some other protocols like 3F, if you heard about them, who is actively solving a lot of the issues that you're talking about. So I would say the approach right now is if we don't feel like we have enough liquidities with our liquidation partner to offload these assets in volumes, we would delay the market launches for now until, like, we have other tools to have active marketplaces to onboard multiple market makers and hedge funds who actively organically trade these assets that can offload them in in a free market way, right? So right now, yeah, there's a lot of limitation, like you mentioned, especially with some of these longer duration private credit bonds. Right now, we are delaying them. We're talking to a lot of these bonds that's already tokenized. They wanted to launch with us, but we feel like to protect users' interest, we have to kind of delay the launch for a lot of these. But yeah, definitely stay tuned. We are focusing a little bit on the shorter duration markets that have less of those issues that you talked about. But we're also working very actively with other protocols. So hopefully we can come to a solution very soon. Also, macroeconomic environments hopefully improve a little bit too. Yeah. So, all right, I think we're at time. But yeah, thanks for your question. Yeah, and I will be around this area. So if you have other questions, just come find me. All right. Thank you. Yeah.